Now let us start duty drawback. It is also very, very important chapter. Practical questions can be asked from this particular chapter also. Now what duty drawback is? Say we have goods are imported. Goods are imported. Then import duty is paid. Import duty is paid. Then subsequently goods are exported as such. That can be in same form, they can be used or they can be say unused. The goods are exported as such. Then we get what? Under section 74, we get what? The refund of the duty so paid. Refund of duty. Either 98% or depending upon the period of use. Depending upon say period of use. At reduced rates, we get what? Refund. And this is basically known as duty drawback. This is an export incentive. This is basically what? An export incentive. Say we have imported any goods 10 lakh rupees and we have paid custom duty say 1,10,000 rupees on the same. Now the goods are exported without use. Then 98% of the import duty so paid is admissible as drawback. Then we are having section 75. In section 75 what has been done is, say we have raw materials say imported, then manufacture or say processing, import duty is paid, and manufacture, processing and other operations are performed on the same. Manufacture, processing and other operations are performed. And then the goods are say exported. Then here duty drawback is allowed as an export incentive. There is an all India rate. Depending upon the all India rate, you are entitled for the drawback. Or if all India rate is not there, we can apply for brand rate. Or in case of the duty drawback, as per all industry rate basically is less than what all industry rate is there. And if duty drawback as per the all industry rate is less than what? The 80% of the duties, then we can apply for say special brand rate. So fundamentally, section 74 and 75, they are dealing with the provisions relating to duty drawback. Then we are having section 75A. Section 75A, it is dealing with interest on drawback. Section 75A, it is dealing with interest on drawback. And section 76, it is dealing with the provisions relating to prohibition and regulation in respect of drawback. 76 is prohibition and regulation in respect of drawback. Now let us start. Let us start the same. Now first of all, when we understand the differences, when we do these differences, entire chapter is completed. With these differences only, basically entire chapter is completed. So what basically section 74 is, as the name suggests, section 74 is drawback allowable on re-export of duty paid goods. Section 74 is drawback allowable on re-export of duty paid goods. Section 75 is drawback on materials used in manufacture of goods which are exported. Section 75 is drawback on materials which are used in manufacture of goods which are say exported. So under section 74, what drawback means? Drawback in relation to any goods exported out of India, basically it means what? Refund of duty Tax or cess? This is integrated tax. And cess is GST cess. As referred to in Custom Tariff Act 1975, paid on importation of goods in terms of Section 74 of the Customs Act. Thus, IGST, that is the integrated tax, and GST cess paid on imported goods is eligible as drawback. Whereas under Section 75, what drawback in relation to any goods manufactured in India, these goods are manufactured in India and exported means what? Rebate of duty. Rebate of duty excluding what? The IGST leviable under Section 37 or the compensation cess leviable under 39. This is excluded. Chargeable on any imported material or the excisable materials used in manufacture of such goods. So under 75, the IGST and GST compensation cess leviable on the imported material or excisable material is not eligible for drawback. The same is say not eligible for drawback. GST has to be taken as credit or refund as per the provisions of what? The CGST Act or the rules made thereunder. Whatever CGST has been paid or GST cess has been paid. Now under Section 74, the goods must be capable of being, say, easily identified. Under Section 74, the goods must be capable of being easily identified. Whereas under Section 75, there is no criteria of such identification because raw material is imported and then subsequently processing etc. is performed. Whereas under Section 74, same goods are to be exported. So the goods must be capable of, say, being easily identified. Then, so here eligibility, all goods are eligible but subject to their identification. Whereas under 75, drawback is allowable in respect of notified goods only. Then user criteria, here duty drawback is allowed even if the imported goods, they are taken into use and then exported. Even if the imported goods have been, say, taken into use and then exported. Whereas under 75, if new goods have been manufactured and then they are taken into use and then exported in form of second-hand goods, export, say, duty drawback will not be allowed. So under 75, goods, if goods manufactured from imported material are used in India, if goods manufactured from imported material are used in India and then subsequently exported, duty drawback shall not be allowed. Then what is the nature of the goods exported? The goods, exported goods should have been imported and custom duties to be paid thereon. The exported goods should be, say, have been imported and custom duty have been paid. Here the goods exported may be manufactured or processed from imported as well as, say, indigenous material. What is the rate of drawback? Here 98% of the import duty paid is eligible as drawback. If the goods are not taken into use, 98% of the import duty paid is eligible as drawback because 2% is deducted on account of administrative charges. And in case if the goods have been taken into use, then at notified rates, drawback is admissible. Now under 75, duty drawback is admissible as per all industry rate. Under 75, duty drawback is admissible as per all industry rate, and in case if all industry rate is not notified, then the exporter can apply for brand rate. And in case if the duty drawback as per all industry rate, is less than 80% of the duties, if the duty drawback as per all industry rate is less than 80% of the duties, then the exporter can apply for, say, special brand rate. Relating to the time limit for exportation of goods, under Section 74, the goods must be exported within, say, 2 years from the date of payment of duty. the goods must be exported within 2 years from the date of payment of duty or such extended time as allowed by the board, whereas there is no such time limit for exportation under Section 75. Is there any requirement of value addition? For Section 74, there must not be any sort of any requirement of value addition. But under 75, there should be, there should not be any negative value addition. There should not be any negative value addition. And in case, if minimum value addition is specified, the same must be achieved. In case minimum value addition is specified, then what? The same must be, say, achieved. Then there is no requirement as such to bring export proceeds in convertible foreign exchange under Section 74. There is no requirement to bring, convertible foreign exchange under 74. But here, under 75, the goods must be brought in convertible foreign exchange. Goods must be brought in, say, convertible foreign exchange. Export proceed basically. Export proceed must be bought in convertible foreign exchange within the time limit specified under FEMA. Then, under 74, under Section 74, what rules have been framed? Re-export of imported goods. Re-export of, say, imported goods. Custom duty, drawback on custom duties rules 1995 has been framed, whereas under 75, customs and central excise duties drawback rules 2017 have been framed. Under 74, the goods can be exported in form of baggage. 75, the goods cannot be exported as baggage. So these are the basic differences under 74 and 75. Basically, you must have understood. Now, under Section 74, in case goods have been taken into use and then exported, if the goods have been taken into use and then exported, then the duty drawback is admissible in this manner. Now, it is what? If length of the period, it is length of the period between the date of clearance of goods for home consumption, between the date of clearance of goods for home consumption and the date when they are placed under customs control for export. Length of the period between the date of clearance of goods for home consumption and the date when they are placed under customs control for export. If it's not more than 3 months, then 95% of the import duty so paid will be admissible as drawback. 95% of the import duty so paid is admissible as drawback. If it's more than 3 months, but not more than, say, 6 months, when we have cleared the goods and now we are placing again under the customs control for export, it's more than 3 months, but not more than 6 months. It is 85%. Then it is 3 months time frame. Then 6 to 9, it is 75%. Now 9 to 12 show, it is what? 70%. Now remember, this is this. Earlier it was 95, 85, 75, 10% decrease. Now 5% decrease. Then 12 to 15 months, it is 65%. 15 to 18 months, it is 60%. And more than 18 months, it is nil. This is very, very important. Can be asked in your examination. They can ask you to calculate the amount of drawback. And in respect of motor cars, and goods which have been imported by a person for his personal or private use, in respect of motor car or say goods imported by a person for his personal and private use, then drawback of duty will be equal to what the import duty paid in respect of such motor car or goods. This as reduced by 4%, 3%, 2.5% and 2% for every quarter of part thereof. So here you have to calculate it. Say it is say 4% in the first year, then in the second year 3%, and in the third year it is 2.5%, and in the fourth year it is 2%. Say 100, 1 lakh is the duty which we have paid, and the goods have been imported for personal and private use, and say it's a motor car, it has been imported for personal and private use. How much drawback will be admissible if the goods have been exported, say 2 months and 3 days, only 1 quarter it has been used for the first year, we'll get 96%. We reduce by 4%. Now it is say 1 year, 2 months and 3 days. So it will be 4 quarters for first year. It will be reduced by 4%, that is 16%. And it is 2 years, 2 months and 3 days means 1 more quarter. 1 more quarter, the reduction in the second year is what? 3%. So the total reduction works out to be what? 19%. So we will get what? In 1 lakh, 19% is the reduction, 81% we will get the admissible drawback. So it is 16% in the first year reduction, then cumulatively it will be 28% in the second year, then 38% in the third year per quarter or part thereof, and then 8% means what? 46% in the, the fourth year, and then no drawback will be, say, admissible. Then here, so this was basically the percentages of drawback which you have to remember. Now basically for section 75, we have what? Framed, customs and central excise, duty drawback rules 2017. Now basically rule 3, it is dealing with what? All industry rate. Rule 3 is dealing with all industry rate. Here duty drawback is allowed as per the provisions of the all industry rate, and this all industry rate has been fixed. How much quantity of the material is used, out of which how much is the imported material, how much duties and taxes have been paid on the imported materials, how much packing material, etc. is used. Having regard to the same, all industry rate is basically announced, and that has been given in rule 3. So you can go through once that all industry rate, and basically if you have not paid any duty, or the duty has been rebated or refunded in other form, then all the amount of drawback will be reduced by the amount of the refund or say non-payment of the duty. And in case if the goods have been taken into use and then exported, then drawback will say not be admissible. Then we are having say rule 6. Rule 6, it is dealing with what? The brand rate. It is dealing with the brand rate. In case if duty drawback is not, all industry rate is not announced in respect of the goods, then the exporter can apply for brand rate. Exporter can apply for brand rate within 3 months of the export, and this timeline for 3 months can be extended for further period of say 3 months by AC or DC. Fees is 1% of the FOB value of goods or ₹1,000, and for further 3 months by the principal commissioner or commissioner, then it is fees is 2% of the FOB value or rupees say 2,000. Then rule 7 is dealing with what? The special brand rate. Rule 7 is special brand rate. In case duty drawback as per all industry rate is less than 80% of duties and taxes. If it's less than say 80% of the duties and taxes, then the exporter can apply for say special brand rate. Then there is one upper limit of drawback. What is the upper limit of drawback? That is, the drawback cannot exceed what? 1/3 of market price of export goods. Here this is the upper limit of drawback, and no drawback is admissible in case of negative value addition, no drawback is admissible. In case of say negative value addition, or if minimum value addition has been specified, the same must be achieved. There is rule 8 that is dealing with the same. If minimum value addition is specified, the same must be say achieved. Now basically a supplementary claim can be raised under rule 16. Rule 16 is dealing with the supplementary claim. If the exporter finds that the amount of drawback which has been paid to him is less than what he is entitled on the basis of say all industry rate or brand rate or special brand rate, then he may prefer a supplementary claim. He can say prefer a supplementary claim. What is the timeline for preferring the supplementary claim? In case of say all industry rate, within a period of 3 months from the date of determination of all industry rate. In case of say brand rate, that is the date of communication of the rates, brand rate or special brand rate. And in all other cases, he can prefer a supplementary claim within a period of 3 months from the date of the settlement of the original drawback claim. Okay. And here, the extension can also be made of by AC or DC. By AC or DC for a further period of 9 months. Fees is 1% of FOB value of exports or rupees 1000, which is less. And by commissioner for a further period 6 months beyond say 3 months period, further 6 months, that is 3 months and 9 months, then further 6 months by the commissioner. Fees is 2% of FOB value of exports or rupees 2000, which is say less. And here, if there is any deficiency, the same will be communicated to the exporter and he has to resubmit the claim. Then recovery of drawback is there. Rule 18, it is dealing with what? Rule 18, that is dealing with the recovery of drawback. In case export proceeds are not realized, say if export proceeds are not realized, say 50 lakh is the export proceeds, on which 50,000 is the amount of drawback which has been granted. 50,000 is the amount of say drawback has been granted, out of which 10 lakh has not been realized in convertible foreign exchange. So here the recovery will be made of rupees 5,000. This will be recovered. So here drawback shall be recovered if the sale proceeds are not realized within the time limit under FEMA. Here drawback will be say recovered. How much amount of drawback will be recovered? That is the sale proceeds not realized, say in our case it was 10 lakhs, divided by the total sale proceeds. Total sale proceeds was 50 lakhs in our case, into what? The amount of drawback paid to the claimant, that is 50,000 rupees. Now, the recovery will not be made. The recovery will not be made if the sale proceeds is compensated by Export Credit Guarantee Corporation and the collection is waived by the RBI, and the collection is say waived by the RBI, and exporter produces a certificate. Exporter produces a certificate from the concerned foreign mission, about the fact of the non-recovery of sale proceeds from the buyer. Then in case if recovery has been made and subsequently, the sale proceeds are realized. If subsequently the sale proceeds are realized within the time limit of FEMA, then say within a period of 3 months from the date of realization of sale proceeds, say after recovery, the exporter produces evidence within say 3 months from the date of realization of sale proceeds. Then the recovered drawback will be paid to the claimant. The recovered drawback will be paid to the claimant, say provided the export proceeds are say realized within the time limit of the FEMA, RBI. Then section 75A, that is dealing with interest on drawback. That is interest on drawback. So here, if any drawback payable to claimant, under section 74 or 75, if any drawback payable to claimant under section 74 or 75 is not paid within 1 month, if the same is not paid within 1 month of the date of filing of drawback, if the same is not paid within 1 month of the date of filing of drawback, then interest will be given at rate of 6% per annum. Interest will be given at rate of 6% per annum okay, on the amount of drawback remaining unpaid. After the expiry of 1 month, after the expiry of 1 month, till the date of payment of such drawback. Still, here fundamentally, if you are not granted drawback within say a period of 1 month, you will be entitled for interest at rate of 6% per annum. After the expiry of 1 month till the date of grant of drawback. Then in case drawback has been paid to the claimant, in case say drawback has been paid to the claimant erroneously, or say it becomes otherwise recoverable under the act or the rules made thereunder. Drawback has been paid to the claimant erroneously, or say it becomes otherwise recoverable under the act or the rules made thereunder, then the same must be recovered. The same must be recovered along with interest. Basically, it will be recovered within say 2 months from the date of demand, and here interest will be levied at rate of 15% per annum. It will be recovered along with the interest at rate of 15% per annum, and interest will run from the date of the wrong payment of drawback, that is date of payment of such erroneous drawback, till the date of such recovery. Till the date of such recovery. Okay. So this is about what? Section 75A. So here on the amount of drawback which has been granted to you erroneously, you will be entitled for what? The interest on the same. Then section 76 is prohibition and regulation in respect of drawback. Section 76 is dealing with what? Prohibition and regulation in respect of drawback. So basically, no drawback shall be allowed in respect of the goods if the market price of the goods is less than the amount of drawback. If the market price of the goods is what? Less than the amount of drawback, or where the amount of drawback is less than rupees 50, then drawback will not be admissible. And in case if the central government is of the opinion that goods are say of any specified description for which drawback has been claimed, they are likely to be smuggled back into India, then they will notify that the drawback will not be allowed in respect of such goods, drawback will not be allowed in respect of such goods, or say drawback will be allowed subject to such restrictions and conditions as may be specified. Drawback will be allowed subject to say such restrictions and conditions as may be say specified in the notification. So fundamentally on section 76 also questions can be asked. So you must remember that what is the upper limit of drawback under 75? It is 1/3 of the market price of the export goods. Upper limit of drawback. There must not be any negative value addition, or in case if any minimum value addition has been specified, the same must be achieved. There must not be any negative value addition, and if minimum value addition has been specified, the same must be achieved. And in case if duty drawback as per all industry rate is less than what the 80% of the duties and taxes paid on the goods, then you will be apply for say special brand rate. If no duty drawback rate has been announced, then we can apply for say brand rate. So this was all about duty drawback under customs.